Want to welcome everybody to our second quarter conference call, our mid-year market update for 2022. I'm Lynn Adams.
Justin Gross.
We're principals here at Adams Financial, and we just wanted to take some time to do a webinar today and give everybody opportunity to see some of the data that's driving this market cycle. It's definitely been more of a challenge this year than we've seen in a while. But I think people are responding to it in different ways, and we want to just kind of get out with some information and welcome questions. Some of our guys are monitoring the emails as well as the webinar channel, so we'll try to answer any questions that we get as we go as well. So real quick, just have to say from a compliance standpoint, everything that we present here is for educational purposes only. Nothing that we talk about should be considered investment advice or a recommendation to buy or sell a security. We are registered investment advisors through Cetera Advisor Network, and Cetera is a member of FINRA and SIPC. So with that, we'll get started. Probably the first thing that we would like to just talk about is the market. Now, the S&P 500 is not the entire market, but it is a really good indication of the overall market. It's the 500 largest companies in America. This is a graph of how the behavior of that index has been for the last 25 years, give or take. And one of the things that we look at when we're looking at the stock market is not just the price of the index or the price of returns, but the valuation of things. And so we can kind of see a lot of activity here leading up to the peak that we had right around January 1st, not just in the price, but in the actual price to earnings ratio. You know, if you look at this January 3rd data point, stocks were selling at 21 times annual earnings, which is a pretty expensive price tag. Because if you think about that, if you're just to go buy an individual company, Justin's, superstar business, and I say, I want to invest in your business, Justin, and I give you $1,000, and if I'm paying 21 times earnings, then I can extract, I'm going to get about $50 a year in revenue from that, earnings from that. So it'd take me 20 years to get my money back. So the higher the multiple, the more expensive the stock, right? Now with the recent pullback, we're going to talk about contributing factors to that. We're finally back down to 16.3 times earnings, which in the grand scope of things is a more normal price.
Yeah, historically that's in line with almost average,
right?
Which would tell you that we began the year a little bit by historical terms overvalued. But that can last for a long time too. That can go up beyond normal. So we're kind of at a normal earnings valuation right here.
In fact, there's a chart here to show that. So this is, again, a similar 20 some odd year period. And you can kind of see that it's the normal is 16.8 times earnings, and we're at 16.2. So it's really been probably since 17 and maybe for a brief period in 19 that we had stocks selling at a normal valuation based on how much earnings they're producing. Now you can talk a lot about how did we get to this really high valuation. I mean, obviously this spike down was when COVID hit and everything kind of shut down. And then I think this move up from here, this 100%, from the bottom to the top, which is almost an aberration, but that was just from all the stimulus. I mean, you add it all up, it was about $9 trillion of total stimulus into the economies. And it created that bubble. And now we're in a process of moving that out. The Fed is raising rates. They're doing, they've stopped their asset repurchase program. So there's money coming out of the stimulus, sort of going the other direction now. So
somewhat of an unwinding.
Yeah. So when you look at year-to-date returns, obviously none of us ever want to see returns like this, but it is part of the investing process that you have periods of time where things are negative. The S&P we just spoke about, by the time you factor back in dividends, it's down 17.5 year-to-date. The NASDAQ, which is more oriented towards like growth stocks, which is what a lot of the more aggressive growth and growth strategies use stocks in that space, it's down 29. Russell 2000, which is the small company index, down 20. EFI is international, down 19. Emerging markets down 17. The bond index, I mean, Barclays Ag, which is really unusual to see it going down when stocks are going down. Normally there's this flight to safety trade, but it's down 10. And then the more, ultra aggressive type speculative assets, and we could give you a whole list, but Bitcoin seems to be pretty well known, is down just under 60% through the mid-year point. That's a pretty ugly start to a year in anybody's book.
Yeah, and some of the, speaking of the unwinding from COVID going back to 2020, some of the darling stocks, and we won't mention individual names, but then during that period that went up a lot, are down 60, 70, 80%. You've got companies that are lose 2/3 of their 3/4 of their market value. That's significant. So these numbers are not great, but there's certainly individual stocks that are far multiples worse than this.
So let's talk about this piece, because I mean, as I said a minute ago, and I don't mean to baby step it, but when you invest in stocks for the long run, you're going to get a year every 4, every 5, every 10 at least, where you're going to get a correction. It's a natural, normal part of investing in stocks for the long run. It is highly unusual to have a bond market sell-off like this. This chart right here, there's a lot of information on here, but it sort of illustrates what the bond market sell-off is doing. And so I want to spend a little time here. And this is probably the most insightful slide here on our whole deck, because people don't understand why it feels so bad. But on the left-hand side, it shows us the financial crisis back in 2007, 2009. And we all know that the stock market from that period of time was down 50, 55%. But you can see the bond categories are right below it, right? They were up 20, 25%. And there's other categories. Gold was up, real estate was down, energy was down, volatility was up. If you look at the pandemic, when COVID hit the US and the markets really responded to it, stocks were down a lot, 27, 33% in a very quick amount of time. Again, investors flocked to the safety of bonds, the perceived safety of bonds, bond values went up, the other asset classes went down. This situation today is very different, because the stocks are down not even as much as some of the other cycles, but the bond market is down double digits, and in the longer term bond index down high double digits. And so investors don't generally own just stocks. They usually have a portfolio with stocks, bonds, cash, different things. So if you took a typical 60% stock, 40% bond portfolio, which is probably the most widespread, sort of the median investment allocation for most investors in the US, you would see that in the financial crisis, that type of investment strategy would have been down about 18%. In the pandemic, would have been down 12%. But in this particular crash, if we would call it that, a 60-40 blend would be down 23%. And that's why this feels so rotten, because it's not just the stock side, it's the bond side. And so, you can kind of see our little chart here to show you how much the decline was in the 60-40 strategy. Even the average of the last 5 corrections, 60-40 would only been down 7%. So I think that the bond piece is really the culprit on all that's happening here. And I think that's where we have worked diligently to make some changes in what we're doing to adjust for, that component.
Yeah, you've got 2 historical relationships that have broken down in 2022. One is the bond, and it makes a big difference in the overall portfolio. You've always heard people generically say, don't put all your eggs in one basket. That's because that classic diversification tends to hold true, and it helps you out when there's bad times in other assets. This year, there's kind of been one basket.
Yeah.
And no matter where you put your eggs. And so the bond relationship is a big component of the overall returns that have not helped balance each other out. The other down here is volatility, long volatility. We have certain pieces inside of portfolios that are designed that if things go really wildly crazy and there's fear
on the downside,
to the downside that causes fear, would cause these assets to appreciate inside of portfolios. Mm-hmm. And as bad as this year feels, and whether that's from war or political or whatever gets people excited, the market has not indicated that same fear.
Right. Volatility has been pretty modest.
And that's a historical truth.
Yeah.
Is when markets give you these types of returns, volatility usually spikes.
Right.
And this year it has not thus far.
Yeah, and I mean, and we still have that trade on. In fact, our largest core holding is an S&P blend fund that has an option on volatility. And I think that consciously, our belief is that just looking back in history, when you get to the bottom, like when you really get to the bottom of most of these ugly cycles, that when the retail and average investor decides that they're going to throw in the towel, like I've had enough, I can't lose anymore. And it's just like, sell whatever I've got. You get this capitulation. And that's where that long volatility piece might help us because we still have it. So yep. If we do get a fire sale type environment somewhere in the next however many months, if it comes, that piece is still there to help us, but it hasn't really helped thus far. Let's talk about this bond market volatility thing. You know, we met with a lot of folks in February, talked about vision for the future. We knew rates were going to be higher. Talked about the challenges it might bring to bond investors and ultimately stock investors as sort of a temporary thing. I would say that looking at what has transpired since January to now in the bond market is well beyond our expectations of damage in the bond market. You know, and this chart shows you the negative 13% entry year decline on the US bond market, the Barclays Ag, relative to 50 years. I mean, it's the worst. It's the worst decline in the bond market. And since, you know, I was born, basically.
By multiples.
Right. Yeah. You know, yeah, a bad year in the bond market is -2, -3, -1. So somewhere in the double digits is very, very historic. And I think this is really the root of the pain. And it's coming because the Fed is just pushing rates up. And the market is listening to the Fed. And they're saying, as long as we have this persistent, really high inflation, they're going to keep raising rates. And so the market is pricing in as if the Fed's going to raise rates 2 or 3 or 4 more times, because the market's trying to get ahead of what the Fed's actually going to do. The good news about this, the silver lining, is that as rates have gone up for those that still own bonds, the yields are higher. So if you had a 2% bond and now the current bond of that same kind of issue is at 5, even if you've lost 10%, well, by de facto that is paying 5, you know, if you hold it for 2 years, you would kind of make back what you would expect to the loss there, but it's still it doesn't bring that much warm fuzzy to the table right now when you see, oh my gosh, the bond values are down, but the yields are higher, and it is only a matter of time before the Fed will stop raising rates and you will just collect those yields, and it'll be a good time to own bonds, but not in the ramp up period.
And you know, it's hard to have the crystal ball that works all the time, but we were not caught by surprise that rates were going to rise. We've been preparing for that for years. And I don't think that many of the bond positions in our portfolio are reflective of just a long aggregate bond. So there's things that we've done in preparation for this, shortened duration to lessen the impact, amongst other things that may not have our bond positions down quite that much. But going back to the volatility standpoint, one of the reasons you might continue to own bonds, even if you think rates might rise, is the flight to safety. And there hasn't been that fear-driven panic to push people to the safety of bonds. So it's been a really tough bond market.
But this is really the culprit of what's happened this year. So the obvious question is going to be, well, when is this going to stop? When are we going to have interest rates stabilize and the bond market stop going down and subsequent leverage in the stock market get back to normal, so on and so forth? And it's really right now, it's all about inflation. We just saw the actual July figures came out for the end of June, and they were at right under 9%. So we're 8.2, 8.8 for CPI. It is not coming down yet, but there is the belief that it will soon begin to turn, that rates are getting high enough to slow down growth. Another part of the slowing the economy is pulling money out of the economy. And this is sort of the Fed's mapped out strategy to essentially reduce their balance sheet. You know, they bought a bunch of assets and dumped a bunch of cash into the markets during COVID. And so now they're actually selling those assets back to the open market, which in essence is bringing dollars back in, and they're basically retiring those dollars. And they've got a multiple year plan to continue to do that. But between reducing the money supply and raising interest rates, there's a lot of monetary pressure that will slow the economy. The question is how much will it slow the S&P 500 growth or stock valuations? It's had a pretty pronounced effect so far, but we just don't know when it will turn. So here's our strategy. As Justin just said, we've already limited our exposure to the bonds that are really hurting people the most. We really don't own very much in the intermediate to long-term government bonds or even investment grade bonds that have been taking the blunt of the damage. We have substituted real estate income in a lot of the bond categories. We brought a piece in back in September and October, and then we added to it again in February. Those pieces have held up well. Now, we're not talking about residential real estate that tends to be more fickle in price. We're talking about commercial real estate with long-term leases with typically Fortune 500 tenants that, a whole portfolio of buildings that's just paying income. But we've put some of those pieces in place and they're working thus far. Our strategy for stocks, we felt like there's some opportunity in this sell-off to try to be tactical about trying to buy positions that have been distressed the most. So we've created more of a core, which is our traditional indexing, low cost stuff. We've also added a tactical piece where we can put a little bit of money into some areas that we think we can kind of bottom fish for. And so that's something that we've added. Our tactical component of our portfolios, the risk on, risk off stuff, we are risk off as a firm. So in the tactical pieces that would either be in stocks or out of stocks, we are out of stocks. And fundamentally, I think that's been a process to go from risk on to risk off. We started we first actually got first out in December, but then we were triggered back in, and then we got out again in January, and we've kind of been more and more out, and we're totally out in that sector. Probably, I don't know how long it'll take for the 200-day moving average will get down to the market, but at some point we'll re-enter. We have a lot of dry powder. And then we do have some structured outcome things that we're doing. And there's some really unique opportunities where if you commit to a 5-year investment that you can get a minimum return of, I've seen them as high as 3%, and then some participation in the upside of one or more of the indexes. So we're using some structured outcome products as well. So there's some things that we're doing there. We think these are helping, but it doesn't change the fact that, it's been a bad year. Visually, if you're in one of our managed accounts, these are our models. And just to kind of illustrate, so like an aggressive growth model, if we were 100% risk on, you'd be 99% in stocks. But right now we're at 70, just a small piece in fixed income. And then this is tactical trend, which is sitting on the sidelines for the most part, and a little sliver of real estate. And the growth, normally you'd be at 82%. Right now you're 56%. So not as much as normal for equity exposure. With 26% in trends, kind of parked in dry powder, and about 17% real estate. Total return, which would mimic your typical 60% stock, 40% bond, right now is 35% stock, only 11 in fixed income. We've moved a lot of that fixed income over here to real estate. And then the tactical on off, we're basically off. So that's basically cash right now. And you can see that for balance and inflation protection. Like our most conservative clients, they only have 8% in equities, still got 45% in fixed income, but we're using some inflation-based stuff there, and then some trend and real estate there. But this is sort of a nice snapshot of our overall models. And if you haven't spoke with us for a little bit and you look at this chart, you can kind of get a sense for where your account is positioned today. So hopefully you guys find that helpful. I want to talk a little bit about stocks as we wind it up. At some point, stocks get cheap so that, people got to step up and buy them. There is value in these companies there, and there's a disconnect today between the value proposition of stocks versus what people are paying for stocks. The disconnect, I think, is coming from the fact that the money supply is being siphoned away from the market. And people who maybe had borrowed money to invest or had leveraged investments are unwinding that leverage as the cost to borrow goes up. But what I think the average person doesn't realize is that corporate earnings are still rising, and not just rising this year, but they're looking at projections and what's in the pipeline, and they're projected to continue to rise. On the left, it shows you the corporate earnings for the S&P 500, and this is almost real-time data. It was published at the end of the month. You can see that corporate earnings are still projected to be very healthy. On the right-hand side, this shows you the three colors. The gray line is the month-over-month earnings for the S&P 500 companies, and they've grown, 6% since the beginning of the year, actual earnings. But what's happened is the multiples have come down. At the beginning of the year, people were paying 21 times earnings. Now they're paying 16. So the money is just being siphoned out. It doesn't mean that the health of those underlying companies isn't good. It just means there's less money purchasing stocks.
It's not this simple, but I sometimes think of it as like the mathematical component versus the emotional.
Mm-hmm.
And the emotional part is being sucked out.
Right.
But earnings, some people would find that shocking that earnings are growing.
I don't think people realize it.
Thinks it feels so bad.
Right. This is to Justin's point, the consumer sentiment index. They go out and survey however many thousands of people and say, how do you feel? And there's a measurement. 120 is everybody thinks everything's amazing and it's never going to get worse. It's just euphoric. 40 or 50 means, I'm never going to spend any money because I think that, the world's going to come to an end. So there's this range, and they take this survey every month. And one of the things that's always been a leading indicator for stocks as far as when's a good time to purchase stocks is the consumer sentiment index low. And what you're seeing on this chart, here we are, we're in 2022, and the score is 50 as of June. 50 is the lowest it's been in 50 years. So the average person right now feels like this is the dog days. This is the worst ever. And I mean, more so than even the Great Recession in 2007 to 9, more so than, the Gulf War, more so than, coming out of Vietnam. I mean, so the general consensus about the consumer and their sentiment for economic growth is very rotten. And this shows that the average return 12 months after these bottom points for consumer sentiment, the average is, 25% bounce. So, and for stocks. So I just think that we're setting ourselves up for what I believe will be a really nice, healthy period for stocks. We just don't know when it's the right time to press the go button. You know what I mean? We're not, and I don't know that it's going to be telegraphed. The Fed's not going to say, okay, we're done, because they won't know. So our philosophy is we're starting to bottom fish, right? We bought a little bit of some growth stuff, just nibbled at it a couple of weeks ago. We bought some individual corporate bonds on a real small piece, but we've got a lot of dry powder in all of our accounts with all our clients, and we're gonna bottom fish here for a little bit. And this chart shows that when you're buying stocks, if you look at it in just what you're going to get in 12 months, there's this huge range of returns that we've seen. In 1 year, you could be down 40 or up 50, right? But if you understand, we're buying things today that we are buying for our clients for the next 5 years, for the next 10 years, next 20 years. And if you look at it through the lens of a 5-year time horizon versus a 3-year or 1 year, and there's been a couple of 5-year periods that maybe you were down 3, but there's a bunch of 5-year periods you were up double digits. And so we're trying to just bottom fish and kind of think we've had this dry powder and we have protected some of the stuff going down by a noticeable degree, but we have to redeploy it and try to get in at some lower prices for the next 5 years.
Yeah. I mean, we've had some savvy investors and clients call and say, should we add right now?
Right.
And nobody knows the real answer to that. That's to be determined in the future, but it's probably not a bad idea from some of this factual data to start to add. You don't have to be the hero and call the bottom and say, I'm going to dump it in all right now, but start to nibble and start to, average in.
Yeah. A couple of last slides and we'll wrap it up. When you're trying to figure out when is the market going to turn, it's not going to be after the economy shows signs of improvement. I'm going to show you 6 little charts. These are 2. Historically speaking, when we've had a big correction, the market finds a bottom and begins to turn up before the economic data reveals that things are getting better. The global financial crisis, the market started turning, as early as early spring. And it was maybe 2 months later or 3 weeks later, it kind of depended on when you would look at these bottoming points, that the market started revealing improvements in GDP. When COVID hit, the market began to turn back at the end of April. It wasn't until July that GDP started to turn employment numbers and things in a positive direction. In 1980s, we had a double dip recession. The market began to turn, somewhere mid-spring, early summer. It wasn't until the fall that GDP started to show it. The S&L crisis in the 90s, the market started turning around in late September. It wasn't until January the following year before the GDP figures and that data showed it. Same for the Eisenhower recession and same for the stagflation period in the 70s. Like it is very commonplace for the market to find a bottom and begin to move up before economic data reveals, higher numbers. So we won't know when we've really found the bottom.
Yeah, the market tends to turn before the data and certainly before people start to feel better.
So that's, we had a couple of technical difficulties, so we don't want to go too long, so we didn't get time to do the questions. But for everybody that sent questions, we're going to follow up with you individually. But to conclude and stay on schedule, we've made some adjustments and some of them have worked out well. I mean, we did begin the process of going risk off in January. We stayed moving in the risk off direction all the way through early March. Second quarter, we really didn't have the same losses that the market did overall. The bond market has been historically difficult. And we began in September to make some choices around fixed income that moved us a little bit away from some of that, but not nearly what we could have done. I mean, had we known we had a crystal ball, we'd moved all of it out, but we didn't. We stair-stepped into it. We are positioned well now. We don't own a lot of long-term bonds, except the Fed continues to do its interest rate hikes. I don't think we're going to get too much pain from what we have left. We have a lot of dry powder. And we are starting to bottom fish. We are starting to look at things that we think in the next 3 to 5 years will pay our clients for being invested. And then the last piece is we're really looking at the 200-day moving average. As the 200-day moving average begins to get in the range where prices of stocks are, then we'll look to re-enter a little bit more as a whole versus just these little nibbles here and there. Anything else you want to add?
It's been a difficult year, no doubt. Weathering the storm is never fun. That's what we're doing right now, trying to protect capital. Maybe if we get the opportunity, hopefully, to reinvest some of that at lower prices. But it's an important, maybe the most important part of the process.
Yeah. So we'll respond to your questions. We'll suit you back. We'll get back to you individually. We appreciate you taking time to watch our mid-year market update. We appreciate the opportunity to serve you and your families. And with that, I'm going to read the required disclosures. These are the views of Adams Financial Partners and should not be construed as investment advice. All information is believed from reliable sources. However, we make no representation to its completeness or accuracy. All economic and performance information is historical and not indicative of future results. Please consult your financial advisor for more information. The S&P 500 index is an unmanaged index representing the largest 500 companies in America. The Barclays Aggregate Index is an unmanaged index representing the overall broad bond market. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into the accounts of inflation, fees, and expenses associated with investing. Past performance does not guarantee future results. Thank you for your time today. Have a good day.